let's talk about the moving average convergence divergence, better known as the MACD. So this is a very common technical indicator, and it's on the bottom of the screen right now. So from the high level view, what you need to know about the MACD is it's a momentum oscillator. Similar to the RSI, it tracks momentum, it tracks trends, and it's an oscillator. It goes up, it goes down. So if you want to get into the nitty gritty of what this indicator, this technical tool is showing you and how it's calculated, you first need to know it involves two different numbers. The first number is the 12 exponential moving average, which is the white line. And the second one is the 26 exponential moving average. So we have a shorter time frame, the 12 EMA, and a longer time frame, the 26 EMA. So for those of you who don't know, exponential moving average, it's pretty similar to the simple moving average when you're taking the average of most likely the closing price of the previous X amount of bars. So for simple, they're all equally weighted. And with exponential, there is more emphasis on the most recent bars. The most recent bars are more significant. They have more weight in the equation. That's the difference between simple and exponential. So the simple, once again, is in the white, and the kind of purple pink one here is the 26 EMA. So the MACD, the moving average convergence, divergence, is the difference between the two. You take the 12 and you subtract the 26. So you would take the white line and you subtract it. So that's exactly why around here on October 18th, you take the white, you subtract the pink, that's 0 because they're at the same value. And that's exactly why on that day, this blue line, which is the difference between the two, was exactly at 0. You could see that the 0 is over here. So once again, you take the 12 EMA and you subtract the 26 EMA, and that's what gives you the MACD, and that's this blue line. Well, there's a whole nother line on the chart. What is this orange line? Well, that's actually when you add in a kind of a smoothing factor. So what you're doing is this orange line, also referred to as the signal line, is the 9 exponential moving average of the MACD. So it's the 9 EMA of the blue line, also referred to as your signal line. So what you're looking for here is behind that, the third thing on the chart is a histogram of sorts, and that's the difference between these two lines. So let me, for now, to not confuse anyone, let me hide this. The histogram is the difference between the two lines. So basically the blue minus the orange. So as they get farther apart, obviously the bars get more and more. And then if the blue is below it, that's why you have red, because you're subtracting from a negative there. And then if they're equal, that's exactly why the bars are 0. So this histogram is just the difference, the magnitude between the orange and the blue. Obviously it's the orange taken away from the blue. So the final thing you want to know here is the crosses. And this is what people use for trading signals. So when it crosses, that's a signal. So right here, people would have used this as a signal, obviously, because the orange was crossing on top of the blue. So that's a bullish signal. And then more recently, you have the orange crossing under the blue, and that's kind of a bearish signal. So you could look at it as like bullish as in buy, or you could look at it as bearish as in sell, as in if you were using this straight up, it would tell you to get in roughly in here, and then you would be selling a little bit later around here. That's one way you could use it. Like many of the technical indicators we discuss, I think it's more appropriate to pair it up with another indicator, such as the RSI. Yes, this is another technical oscillator. It's another momentum tracker, another trend tracker. This is a little bit different because obviously the MACD is the difference between two exponential moving averages, while the RSI is relating the relative gain over the previous X bars compared to the relative loss over the previous X bars. So a little bit different, but kind of the same, I guess, overall idea from the high level of what it's trying to track, but just some nuances there. So I think you could use this in various ways. So you could look at the signal for maybe like an entry or an exit. You could look for that cross. Sometimes other people, what they like to do, and I think this will be better illustrated on a Tesla chart. Let me just bring up the MACD here. Let me drop this. Is if we look at the 2-hour Tesla chart, let me make this a little bit bigger and let me make this a little bit smaller. So some of these times, right about here, you're going to see that you have overextensions on both the RSI and also in the MACD. So for example, what I'm talking about is the RSI was above 70. It's clearly in the overbought territory, very bullish momentum, potentially too bullish, potentially running out of steam. And on top of that, you had large bars, as in there was a big difference between the MACD and also the signal line. And people will use that as, okay, the trend has kind of run its course. So if you use that, well, the first time, yeah, it did come down, not too much. The second time that I have measured out here, if you use that, okay, clear overextension, the bar was pretty big difference. And 2 days later, there was a considerable sell-off. So sometimes this is another example of using multiple indicators together can be pretty solid. Another way you could use that is, let's mark out, let me delete these two just so there's no confusion of what's going on. Let me mark out oops, not that one. I don't want that one. I want it to be a bar over right about here and then also here. So a couple things to point out on this one. Once again, you had kind of these red bars. You could use the opposite, but what I'm really trying to illustrate, and let me drop the RSI, is similar to RSI when we see divergence, as in the price went higher, but the RSI went lower. That's bearish divergence and vice versa. You can use that once again with MACD. So check this out. Tesla went from about 1,007 all the way down to 988. But look at these lines. See how the lines are actually higher? Once again, that is bullish divergence. Price went lower, but the lines, both the MACD line and the signal line, were actually higher even though the price went lower. Lower, but higher, that's bullish divergence. And look what happened right after that. We actually went Tesla had a pretty nice rally from 981 all the way up to 1,200. So even if you were looking for that type of divergence and then you were looking for maybe a better entry, well, you could see that from an RSI perspective, it was actually also oversold. So there were two different signals that when used together were telling you that Tesla was a very strong buy right around 1,000 on November 15th. And you could have rode that all the way up to really whatever you wanted to. You could have rode it up to 1,100. You could have waited for the RSI to get oversold and look for this cross, maybe in this zone of 1,150. But regardless, that's, I guess, the strategy of an exit. I'm trying to show you how, yes, you can use this individually, but most of the time it's going to be better when you have various indicators. These are two oscillators. Maybe you want to use moving averages, exponential moving averages. Maybe you want to use time. Maybe you want to use seasonality. That's when it comes up to you and your methodology. But overall, let me drop these. MACD, the moving average convergence divergence right here, is a very, very strong tool. From the highest level, it's mapping out momentum. It is the 12 exponential moving average minus the 26, and those differences create the blue line. And then if you apply the 9 exponential moving average to the MACD, that's where you get this signal line. People look for the crosses upward and downward, and that's common signals. I personally think it's best used when also in addition to other technical indicators. Once again, that's the MACD, MACD, the moving average convergence divergence technical indicator.